My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to teach and educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Tonight, I want to share some of my accumulated wisdom. Believe me, I've been doing this thing for a long time because there are so many different things you need to balance in order to be a great investor that it can be hard to keep track of everything that you need to do. And a lot of this stuff is much more important than the day-to-day action in any particular session. Without the right discipline, the right framework, the right, dare I say, philosophy, well, you're going to get yourself into trouble. But I also know that big-picture financial advice can be hard to process. A lot of it seems downright contradictory to most people. We tell you to have conviction, for instance, to stick with the companies you believe in. Then we say you need to be ready to change your mind on a dime when the facts change. You need to be cautious because it's so dangerous out there. But you also need to be ready to pounce on opportunities when they present themselves. You need to be skeptical. But you also need to know when to suspend your belief, your disbelief. You need to avoid chasing stocks that have run too much. But you also shouldn't care too much where a stock is coming from if you believe it's headed higher. You know the rules. It doesn't matter where a stock has come from. It's where it's headed to. Believe me, I get it. I get it. If you take all my rules literally, you're going to be running around in circles while tearing your hair out. I mean, how do you think I went bull? So tonight we're going to take a step back. Try to put all this discipline stuff into perspective. If you pick your own stocks, the thing you really need above everything else is good judgment. But obviously, good investing judgment is not the kind of thing anyone can teach you in an hour of television or even a year of television, for that matter. That's why I try to help you build good habits. I try to teach you better ways to think about individual stocks and the whole market. I try to give you the tools you need to develop your own judgment. All my best professors in college focused on teaching us how to think, not teaching us what to think. I've always tried to take my cue from them. I want to teach you how to be a better investor, not just tell you the stocks that I think are good investments. The problem is, that's a heck of a lot to process. So let's try to put it all in context. First and foremost, when you're managing your own money, before any other consideration, you need to know yourself. I've said this before, I'll keep saying it because it's so important. You simply can't know which stocks you should buy if you haven't taken the time to really consider what your own personal objectives are, and I can't decide them for you. Do you need to build up your wealth to ultimately make a major life-changing purchase like a home? Are you just trying to get a decent return as you save for retirement? Do you have money to burn that you're willing to take risk on more speculative propositions? Those are all different mindsets. So the truth is, there is no one-size-fits-all approach to investing, and anybody who tells you differently is either dangerously misinformed or flat out lying to you. Probably in order to sell you something. But far too often, people invest in the stock market with the simple, poorly defined goal of making some money. Yeah, all we want to make money. Everybody wants to make money. But how quickly do you want that return? What are you willing to risk to get there? How much can you even afford to risk in the first place? These are really important questions that you need to ask yourself before you start trying to pick any given stock. Why? Because without a clearly defined goal, you have no way to determine which stocks you should be buying. In other words, your 401k, your IRA, or brokerage account do not exist in a vacuum. If you're trying to save up for retirement, a stock like a Netflix might not be the most appropriate place for you to put your capital. On the other hand, if you already got a decent-sized nest egg set aside for retirement and you just want some capital appreciation, then Netflix and the rest of its fast-growing FANG cohorts, Facebook, Amazon, Google, now Alphabet, well, they all seem, well, let's just say they start to look a lot more attractive given that mindset. In short, before you can start making judgments about individual stocks, you need to figure out what your own internal yardstick is going to look like. That's the foundation of good investing judgment, knowing what you need so you can find stocks that are suitable to your particular needs. Let me put it another way. If you want to fly across the Pacific Ocean, you do it in an airplane, a Boeing 747. You don't try to fly across the Pacific in a Ford Fiesta. Now, if you want to pick up your kids from school, taxing down Main Street in a 747 would be, I'd say, really impractical. In that situation, you'd be much better with that Ford Fiesta. How about if you're renovating your house, so you need to go to Home Depot for a metric ton of lumber and tiles and paint and maybe some power tools to get the job done? The Ford Fiesta is probably too small. There's no way you're going to fit it in a 747 in that packed Home Depot parking lot. But a pickup truck would be perfect. This may sound simple, even downright obvious, but it's the same way with stocks. When you're saving for retirement, you want low-risk holdings that will give you a slow and steady return. For those of you who don't have time to research individual stocks, you can't really go wrong with a basic, low-cost S&P 500 index fund that tries to mimic the performance of the broader market. Look, I've recommended index funds endlessly here, and I'm going to keep doing it because they are phenomenal. At their best, they help democratize the incredible engine of wealth creation that is the U.S. stock market. America's a growing country that's very business-friendly compared to the rest of the world, particularly the developed world. And when you buy an S&P 500 index fund, you're basically betting on the long-term performance of the U.S. economy. You know what you're betting on? You're betting on progress. Historically, that's been a very good bet. That's why I always say that you need to invest your first $10,000 in an index fund. Don't bother to try pick individual stocks until you have more money than that. Again, first $10,000 index fund. Now, if you're looking to make slow and steady money over a period of decades, that's a retirement investment really in a nutshell, isn't it? You might also consider certain kinds of individual stocks, especially consistent, steady Eddie companies with big dividends because of compounding. A 4% dividend yield may not sound all that spectacular, but even if the underlying stock goes nowhere, that 4% annual return will double your money in 18 years, thanks to the magic of compounding. Of course, not every investor is simply trying to fund their retirement. And even if you are, that may not be the only thing you want to do with your savings. This is another important point. You can have multiple objectives. You can and should have multiple pools of money. I like to break things up into your retirement portfolio, where you need to be pretty cautious, and your discretionary mad money portfolio, the extra money that you're not going to need in order to support yourself after late-stage capitalism has ground you down and you're no longer able to work. That discretionary portfolio is where you can afford to take more risks in order to generate faster profits. Make sense? But, mighty big but here, for the vast majority of people, your discretionary portfolio is going to be much less important than your retirement portfolio. Because it's not just retirement. If you want to pay for a house, you want to send your kids to college, you should take a more conservative approach to managing that money. Whatever kind of account you put it in, your strategy for college tuition savings or future house savings should look more like your retirement portfolio than that mad money portfolio. So please get to know yourself before you jump down the rabbit hole of getting to know individual companies. Bottom line, trust me, I get it. When you get excited about a particular stock, you often want to dive right in. I've been there before. First, though, you need to consider what you're trying to get out of the market. The answer to that question is not going to be the same for everyone, but everything else stems from it. You can't make judgments about stocks until you know what characteristics you actually value. Let's go to Paul in Texas. Paul.
Booyah, Jim.
Booyah, Paul.
I've noticed the companies, a lot of them will exceed on one and miss on the other in reference to revenue and earnings per share. So as a shareholder in the companies I'm looking for, if they're going to exceed one and miss one, would it be more important for them to exceed on revenue, or would it be more important for them to exceed on earnings per share?
Holy cow, what a great question. You know what? Because I've actually done a huge amount of research on this, and thank you, Paul, for asking it. It's revenue growth. We want to see pure revenue growth. That means that there's demand for the product. The actual earnings per share may be, in some cases, manufactured, literally by tax rate, by buying stock back, but you can't rejigger sales. Okay, know thyself. Always consider what you're trying to get out of the market before you dive into a stock. On Mad Money Tonight, yoga won't help you with the type flexibility I'm talking about. I'll reveal the backbends you should be doing to get your portfolio in order. Then, feeling verklempt about your stock picks? I'll tell you why it's time to snap out of it. And how the late, great Maya Angelou offered some of the best investing advice I've ever heard. So stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.